Liquidity disappears faster than people expect, and behavior deteriorates even faster. That is why most windfalls do not create durable wealth. They create a brief illusion of safety, followed by poor capital allocation, rising fixed costs, and decisions made under emotional pressure instead of financial logic. So if you receive a windfall, your first objective is not growth. Your first objective is containment, because money that arrives suddenly is easiest to lose in the period when it feels hardest to lose. You need to think about a windfall the way a disciplined portfolio manager thinks about a large inflow into a volatile market. New capital changes the system. It changes your positioning, your time horizon, your perception of risk, and the behavior of people around you. In markets, fresh money often chases momentum, ignores valuation, and confuses recent price movement with real opportunity. In personal finance, a windfall does the same thing. It makes ordinary spending feel small, it makes speculative ideas feel reasonable, and it makes you believe you can accelerate life without paying a price for speed. That is the mechanism. Momentum rises, liquidity feels abundant, volatility gets underestimated, and judgment gets distorted before any real plan exists. Most people misunderstand this because they think the danger begins when they start investing. It starts earlier. It starts the moment the money changes your identity. The market does not care whether capital came from labor, inheritance, a bonus, a business sale, or a legal settlement. What matters is how that capital is positioned. Your balance sheet works the same way. If the money enters a weak system, it magnifies weakness. If it enters a disciplined system, it creates optionality. So your first job is to stop the windfall from becoming fuel for an undisciplined lifestyle. You do that by slowing the process down immediately. If the money has already arrived, you move it into safe, liquid, low-complexity structures where the priority is principal stability and access, not excitement. If it has not yet settled, you prepare the receiving structure before you make any outward move. You are not trying to impress anyone. You are not trying to optimize yield in the first week. You are trying to prevent mistakes from becoming permanent. In market language, this is your defensive phase. You hold liquidity because liquidity gives you time, and time restores judgment. When rates are attractive, that liquidity may also earn something while you wait. That is a benefit, but not the reason. The reason is control. Then you calculate the real number. A windfall headline is not an investable number. Taxes matter. Fees matter. Legal structure matters. Timing matters. If the money is tied to a transaction, a payout schedule, or jurisdictional complexity, you do not have usable capital until you have a verified net figure. This matters more than people think because spending decisions are usually made against the fantasy number, not the real one. That is how people commit to obligations they never actually had the cash flow to support. You need to know what is untouchable, what is reserved for taxes, what is available for restructuring your balance sheet, and what can eventually be invested for compounding. Without that separation, everything blurs, and blurred capital gets spent emotionally. Once the real number is clear, you build the base layer. This is where you reduce fragility before you pursue upside. If you have high-interest debt, you eliminate it. If you have variable rate obligations that are draining monthly cash flow, you address them. If your emergency reserve was previously symbolic, you make it real. The biological equivalent here is stabilization of the organism. In markets, survival depends on not being forced to liquidate during stress. In personal finance, survival depends on not letting one surprise trigger a chain reaction. Low liquidity plus high fixed costs plus emotional spending is the household version of leveraged fragility. It fails faster than people expect because each problem intensifies the next. Strategically, this matters because a windfall gives you a rare chance to repair the architecture of your financial life. Most people waste that chance by skipping directly to visible upgrades. They buy what can be seen instead of repairing what quietly weakens them. They focus on consumption before cash flow, status before resilience, and one-time pleasure before long-term optionality. That is why many people lose windfalls fast, even when the original sum looked large. They increased expenses before increasing durability. So here is the operating sequence you follow. First, contain the money. Second, quantify the real net amount. Third, remove the obvious sources of financial fragility. Fourth, create a strict delay before major discretionary spending. Fifth, build an investment policy before you allocate long-term capital. If you violate the order, you invite behavioral risk into every later decision. The spending delay is not symbolic. It is essential. Windfalls distort price perception almost instantly. Yesterday's expensive purchase becomes today's harmless reward. You need a hard waiting period on large decisions because your mind is temporarily running on abundance, not discipline. You do not buy a larger house because you can. You do not upgrade vehicles because the account balance makes them seem small. You do not fund other people's ideas because the money feels available. You do not become the family liquidity provider because others now view your balance sheet as shared infrastructure. If someone asks for money, you respond with process, not emotion. The capital is under review. Nothing is being allocated outside the plan. That protects your money and your relationships at the same time. Now think like an allocator. Once the reserve bucket, tax bucket, and stabilization bucket exist, only then do you define the compounding bucket. This is where most people make the next mistake. They confuse having money with knowing how to deploy it. Markets operate through liquidity, rates, valuation, sentiment, and positioning. If you bring new money into that system without a framework, you will buy what feels urgent, not what fits your risk profile. If equity valuations are stretched and volatility is low because complacency is high, you do not force a full entry simply because you hate seeing cash sit still. If markets sell off and your long-term allocation is still below target, you add methodically, not emotionally. If bond yields become compelling relative to risk assets, you recognize that safe returns with flexibility are not inferior to aggressive returns with fragility. Capital allocation is not about always being early. It is about staying solvent, rational, and able to act again. That means position size matters as much as asset selection. If your first move is too large, your emotions become the real risk. Many people imagine they can tolerate volatility until they actually experience it with meaningful capital. A 20% drawdown sounds theoretical when you have never seen six figures fluctuate on a screen. Once you have, your tolerance becomes real, and reality is usually more conservative than fantasy. So you size positions according to your ability to remain disciplined. If you know a large lump sum entry into equities would make you reactive, phase in over time. If you know an illiquid private investment would lock up too much optionality, cap it or avoid it. If the market rises while you are still deploying methodically, accept that partial participation with good discipline is superior to full participation followed by panic. If the market moves higher quickly after your windfall, you react by sticking to the allocation plan rather than chasing. If the market falls sharply, you react by checking whether valuations, liquidity, and your reserve structure still support measured additions. If rates remain elevated, you react by respecting the role of short-duration safe assets instead of pretending every dollar must be pushed into higher volatility vehicles immediately. If inflation stays sticky, you review purchasing power and tax drag, not your ego. Your edge is not speed. Your edge is process. This is where most people stop, but this is the advanced level. The advanced level is recognizing that a windfall does not only change your portfolio, it changes the correlations inside your life. Spending pressure rises. Social expectations rise. Tax complexity rises. Emotional volatility rises. The mistake is thinking these are separate issues. They are connected. When one part of the system shifts, the others reprice around it. That is why a windfall can create a liquidity trap disguised as freedom. You feel wealthier, so you take on larger fixed commitments. Those commitments reduce flexibility. Reduced flexibility makes market volatility harder to tolerate. Harder to tolerate volatility makes your portfolio decisions worse. Worse decisions weaken liquidity. Weak liquidity forces more concessions. That is the chain. Second-order effects matter more than the initial decision. Buying a more expensive home is not a home decision. It is a tax decision, maintenance decision, insurance decision, furnishing decision, burn rate decision, and future optionality decision. Helping multiple people financially is not just generosity. It is an expectation-setting mechanism that can create recurring obligations and social pressure precisely when you need boundaries most. Funding a friend's business is not just an investment. It is an illiquidity decision, governance decision, information asymmetry decision, and relationship risk decision. This is why sophisticated capital is always sequence-aware. One decision reshapes the probability of the next 10. At this level, bankruptcy mathematics becomes brutally simple. The probability of failure rises when fixed obligations increase, liquidity declines, income visibility weakens, and capital gets trapped in assets that cannot be exited cleanly. Many people who lose windfalls do not collapse in a dramatic event. They become trapped in expensive lifestyles, illiquid holdings, informal loans, private deals, and obligations that looked manageable while the initial cash balance was still large. On paper, they appear wealthy. In practice, they have no room to maneuver. That is not wealth. Wealth is flexibility under stress. There is also a behavioral trap that arrives later, after you have avoided the obvious mistakes. Overconfidence begins to wear professional clothing. You tell yourself that because your first few decisions worked, you now have genuine investment skill. A rising market flatters weak process. A stable economy hides excessive risk. A speculative environment rewards bad judgment just long enough to let ego take control. That is when people create a small side bucket for fun, then quietly let it become material. That is when they justify concentration because a theme sounds intelligent. That is when they start interpreting exclusivity as quality. You must resist that. Any speculative capital should have a hard cap, hard review rules, and a predefined exit logic. If a position grows beyond policy weight because it performed well, trim it. Do not let a good outcome rewrite your risk framework. Now bring it back to day-to-day execution, because keeping a windfall is less about one brilliant plan and more about repetitive control. You need rules that continue after the initial excitement fades. Review household cash flow monthly. Review portfolio allocation quarterly. Review tax positioning annually. Review lifestyle inflation continuously. Track reserve months, fixed cost ratio, taxable exposure, concentration risk, percentage of net worth in illiquid assets, and the share of your capital that remains strategically optional. Do not merely ask whether the portfolio is up. Ask whether your decisions remained aligned with the system. A strong result from a reckless process is not evidence of skill. A modest result from a disciplined process may be exactly what wealth preservation requires. To practice this skill, journal decisions before you make them, not after. If you are considering a purchase, an investment, a gift, or a loan, write down the rationale, the expected benefit, the liquidity effect, the downside, the time horizon, and what would make the decision a mistake. Then reverse test it. Ask what happens if markets fall, if rates stay high, if your expenses rise, if tax assumptions change, or if the asset becomes difficult to sell. If the decision only works in favorable conditions, it is probably emotional. If it still works under stress, it has a better chance of being structural. Simulation helps too. If you are unsure how much equity exposure you can tolerate, paper track a model allocation before sizing fully. If you believe a new lifestyle budget is sustainable, live it for several months before locking in major fixed commitments. If you think you can handle market volatility, test your reaction to drawdown scenarios on paper, not with your identity attached to the outcome. People consistently overestimate their tolerance when risk is hypothetical and underestimate the psychological effect when it becomes real. You should also combine this discipline with other tools. Valuation helps you avoid overpaying when enthusiasm is high. Macroeconomics helps you interpret the interest rate environment, liquidity conditions, and the broader cost of capital. Technical analysis, used modestly, can help with staging entries and respecting trend conditions rather than forcing large allocations into unstable moments. Risk management keeps any single decision from becoming structurally dangerous. None of these tools replaces judgment. Together, they create a framework strong enough to resist emotion, pressure, and narrative. Under pressure, your test is clear. If markets fall, do you still know which capital is there to absorb volatility and which capital must remain liquid? If family members ask for financial help, do you already have written boundaries? If a private investment opportunity appears, do you know the maximum size, review process, and exit logic before you say yes? If inflation persists or rates shift, do you know whether your reserve structure still works? Pressure does not create discipline. It reveals whether your process has any depth. The real reason most people lose a windfall fast is not that they were unlucky. It is that they treated the event as permission rather than responsibility. They let the money accelerate every weak habit already present in the system. If you want to keep a windfall, you do the opposite. You use it to slow down, clarify the real numbers, repair fragility, protect liquidity, control position size, and define behavior before you define ambition. Then the money starts serving a structure instead of serving impulse. That is how a temporary event becomes durable capital. You keep the windfall by refusing to let it become entertainment, identity, or social theater. You keep it by understanding that wealth is not a number on arrival. It is a system that survives stress, time, and your own psychology. And if you go back through this carefully, there is one quiet lever underneath almost every decision. Not return, not prestige, not even opportunity, but the amount of liquidity you preserve before the world teaches you why you needed it.